Hey everyone, welcome to another episode of Investing Kev. We have reached the second quarter of my strategies portfolio. If you're unaware, I created 4 different portfolios where I try 4 different common investing strategies. I started investing on June 1st, and we will see how the year goes with this. We have a portfolio that tracks the S&P 500, a portfolio that's focused on growth stocks, a portfolio focused on dividend stocks, and a portfolio that's a mix of both growth and dividends. If you want to follow along, the link to the spreadsheet is in the description box below. If you like my content, please give a thumbs up, subscribe, and let me know in the comments what you think. Alright, let's get started. Here's the M1 Finance overview. The one thing that I don't like about M1 is that they do a money weighted return for the gains and losses. I don't care much about that. So instead, I like to look at the summary of the total gains and losses based on the cost basis that I've put into the stock and the total gains and losses related to the overall portfolio. These numbers can be found on the spreadsheet. Here you can see that the only portfolio in the green right now is the S&P 500 portfolio, currently up 2.4%. When I look at the growth portfolio, I'm currently down 15% overall. I have lost $99.23 on Teladoc, which is a 34.22% loss. Alibaba is second with $93.13 in losses, and Disney is third with $53.71 in losses. Looking at the balanced portfolio, which is a mix of growth and dividend stocks, my biggest loser is DraftKings. I have lost $103.80, which is a 35.2% decrease. When it comes to AT&T, I have lost $54, which is an 18.3% decrease. And my dividends portfolio is also in the red with a 1.8% decrease. Prudential is leading the way with a 5.74% decrease. I have lost $16.88 on this stock so far. What are things that stand out? Well, I want to share a few snapshots of some stock charts. You can see DraftKings, Teladoc, Alibaba, and Walt Disney all getting hammered. A lot of these companies had earnings report that investors did not like. I also think a lot of these stocks were overvalued, specifically Teladoc, and it's being sold off. There's also a lot of fear, uncertainty, and doubt. Inflation isn't transitory anymore, which was stated by Jerome Powell. It's going to last for quite some time. People are unsure if the market is going to crash, and that's why you see people exiting their positions in big growth names and finding more stable companies. If you look at the Hang Seng Index, which is an index of the Hong Kong market, you can see it's down from about 26,500 points in September 1st to 23,600 now, down about 9%. If you look at the famous ARK investment ETF by renowned investor Cathie Wood, her index was above $120 in September and is now currently $98.60, down 20% since September. And if you look at the S&P 500, it was above 4,500 points. It has only lost 0.24% in 3 months. A lot of people think investing in ETFs is boring, and that's their opinion. A lot of people try to beat the S&P 500 and will fail to ever do it or consistently beat it. What I want to say to you is that boring is okay. Investing in an ETF that tracks the market is fine. A lot of people lose sleep over these growth stocks, while a lot of people who invest in ETFs are sleeping well. ETFs help hedge against the volatility and you have less fluctuation. This is your money and it's ultimately up to you. But if you're an ETF investor who invests in the S&P 500, good for you. I know there's plenty of people who love ARK or other ETFs who have lost a ton of money. So cancel out the noise and focus on your own journey. Boring is okay. So what do I expect in the future? I honestly don't know, especially with inflation picking up. People are scared, but I can't control outside factors. I can only focus on the things I have control over, which are my investments. I believe in these companies long term. Some people may sell out, but I've done the fundamental analysis on these companies. I'm in these stocks for at least a year, so I have at least 6 months to go. We'll see how things are in June 2022 at the 1 year mark. I'm dollar cost averaging through the highs and lows, and that goes for any company in the strategies portfolio. If you believe in your holdings and have conviction, a downturn like this would be a welcomed opportunity to build up your positions as much as possible. For example, do you think Disney is going to go away? I sure don't. I would rather average into the stock at $142 per share currently compared to $190 3 months ago. That $50 difference may not be a lot short term when it comes to fractional shares, but over time that stuff adds up. It's been a rough few months with a lot of news, fear, uncertainty, and doubt happening, but this is where money's made. When the going gets tough and people flee, you double down the positions you believe in long term. Will I care 3, 5, 10 years from now about these stocks going down from September 2021 to December 2021? Most likely not, but I will be glad if some of these stocks rebound and recover and double and triple in price, which at this point allowed me to increase my positions more. Investing is a journey. People need to weather the storms. If you do your due diligence, you're able to objectively understand what's happening and be in a position to make an informed decision which isn't driven by emotions. There is nothing wrong with taking profits or cutting losses with stocks you don't believe in anymore. We all win some just like we lose some. Lessons are to be learned, and the hope is that you make better decisions down the road. If you like this video, please give it a thumbs up. I have a lot of stock breakdown and analysis videos, so check those out. As always, thank you for tuning in. Thank you for helping me grow this channel. Stay safe, and I'll see you all next time.